You've probably driven past a self-storage facility 1,000 times without really looking at it. Rows of identical metal doors, a chain-link fence, maybe a keypad gate. It looks like the least interesting real estate on the planet, a place for people to dump furniture they don't want to throw away. You'd assume it's a small, sleepy business. Low stakes, low reward. The kind of thing a retired couple runs to make a little extra income. That assumption is almost completely wrong. Self-storage isn't a sleepy side business. It's one of the highest margin real estate asset classes in the country, regularly outperforming apartments, offices, and retail on a total return basis. And the way that happens, the actual mechanics behind those unremarkable metal boxes, reveals something surprising about how value gets created in real estate, and something even stranger about human psychology. Here's the number that should stop you. A typical self-storage facility runs a net operating income margin of somewhere between 40 and 60%. For comparison, that's roughly double the average profit margin across all industries in the United States. An apartment building, by contrast, usually nets somewhere closer to half that once you account for maintenance, turnover, and the army of staff required to keep tenants happy. A self-storage facility doesn't need a maintenance crew fixing toilets at 2 a.m. It doesn't need a leasing office staffed 7 days a week. In many cases, it barely needs. On paper, a storage facility looks like a building business. You pour concrete, you erect steel walls, you install roll-up doors, and you rent out the resulting boxes. But functionally, a storage facility behaves less like a landlord operation and more like a highly efficient land monetization machine. The building itself is almost incidental. Construction costs for a storage facility are strikingly low compared to almost any other commercial property type. There's no plumbing running through most units, no elaborate electrical work, no elevators, no lobby, no amenities. You're essentially building a shell: steel, concrete, a door. That keeps the capital cost per square foot far below what you'd spend on an apartment complex or an office tower of the same footprint. And yet, the rent per square foot on a storage unit can rival and sometimes exceed residential rent in the same market. As of late 2025, the average nationwide asking rate for a storage unit sat close to $96 a month, spread across a unit that might only be 75 to 100 square feet. Run that math per square foot, and a storage facility can be pulling in revenue figures that would make an apartment landlord jealous, on a structure that cost a fraction as much to build and requires almost no ongoing service once it's occupied. That's the first crack in the boring business assumption. The building is cheap, the staffing is minimal, and the rent per square foot is aggressive. Multiply low costs by high per square foot revenue, and you get margins that look less like a real estate business and more like a software company. But margins on paper mean nothing if nobody rents the units. Which brings us to the part of the model that actually explains why this industry became a Wall Street darling: occupancy economics. Every storage facility has a break-even threshold, and in this industry, that number tends to sit right around 80% physical occupancy. Below that line, a facility is often just covering its debt service and basic operating costs. Not much is left over. Above that line, something interesting happens. Because so much of the facility's cost structure is fixed, the mortgage, the taxes, the insurance, the single part-time manager, almost every dollar of rent collected above 80% occupancy drops straight to the bottom line. There's no additional staff to hire, no extra plumbing to install, no meaningful new cost at all. The marginal unit that gets rented at 85% occupancy is almost pure profit. This is why occupancy, not size, is the number operators obsess over. A facility sitting at 95% occupancy isn't just doing better than one at 78%. It's operating in an entirely different margin universe because it has crossed from covering costs into harvesting nearly free money. And for a long stretch of the early 2020s, occupancy across the industry was extraordinary. National occupancy peaked around 95% in 2021, an all-time high, driven by a very specific set of pandemic-era forces. People moving, downsizing, converting bedrooms into home offices, and simply accumulating more stuff while stuck at home with nowhere else to put it. Rents surged alongside it. The national average unit rate hit roughly $134 a month by late 2022, an all-time high for the industry. If you were an owner during that window, you were sitting on close to the best economics commercial real estate can offer. Near full occupancy, record rents, minimal costs, and a building that cost relatively little to construct in the first place. It looked, briefly, like a business that could only go up. It didn't stay that way. And understanding why reveals the industry's real weakness, one hiding in plain sight the entire time. Here's the paradox. Everything that makes self-storage cheap and profitable to build is also what makes it dangerously easy for competitors to copy. You don't need architects designing custom floor plans. You don't need elaborate zoning fights the way you might for a high-rise. You need a patch of land, usually on the outskirts of a town where land is cheap, some steel, some concrete, and a fence. Compared to almost any other commercial real estate asset, the barrier to entry is low. When rents hit record highs and occupancy hit 95% in 2021, developers across the country noticed at the same time. And because storage is fast and comparatively cheap to build, an enormous wave of new supply got greenlit almost simultaneously. National construction spending on mini storage facilities went from around $4.2 billion at its recent low in 2021 to $7.4 billion by 2023, a jump of nearly 30% in a single year, and well over 1,000% compared to a decade earlier. That's the setup for a classic boom-bust chain reaction, and it's worth walking through it step by step, because this is the mechanism that eventually reshaped the entire industry.
Step 1. Pandemic-era demand pushes occupancy and rents to record highs. Step 2. Developers and lenders see those numbers and rush to build new facilities, chasing what looks like guaranteed returns. Step 3. Because storage is quick to construct, often 12 to 18 months from groundbreaking to opening, that wave of new supply lands all at once, right around 2023 and 2024, just as the initial pandemic-driven demand surge starts fading. Step 4. With a flood of new units competing for a shrinking pool of movers, this is the part of the story that the glossy self-storage is recession-proof pitch conveniently leaves out. The industry is remarkably resilient to recessions. Demand for storage barely dips even when the broader economy struggles, because people don't necessarily get rid of belongings just because money is tight. If anything, downsizing homes creates more storage demand. But the industry is not immune to itself. Its biggest threat isn't a weak economy. It's a strong one, because a strong economy is exactly what convinces everyone to build at the same time. Here's where the picture gets stranger, and where the industry's real engine reveals itself. If you ask most people why storage facilities are so profitable, they'll say something about convenience, or moving, or downsizing. But the data on how long people actually keep their units tells a different story. The average length of stay for a storage tenant is around 18 months, and that number has been climbing, not falling. Only about 12% of tenants store for less than 3 months, the kind of short-term, I'm between apartments use case most people imagine when they picture a storage renter. Meanwhile, nearly half of all tenants stay for over a year, and a meaningful share stay for years on end. Quietly paying a monthly bill for a unit most of them could probably empty out in a weekend if they tried. This is the counterintuitive insight underneath the whole industry. Storage facilities aren't really renting space. They're renting inertia. The product being sold isn't square footage. It's the ability to defer a decision indefinitely. Once your belongings are in a unit you're not actively looking at, the psychological cost of dealing with them drops close to zero, while the cash cost of keeping them stays exactly the same every month. Behavioral economists have a name for this pattern: the tendency to keep paying for something rather than confront the effort of sorting through it. And self-storage operators, whether they'd phrase it this way or not, have built an entire industry around it. That's why churn is lower than you'd expect, and why rate increases on existing tenants tend to work so well. A renter who has kept a unit for 2 years isn't comparison shopping other facilities every month. They've mentally filed the bill alongside their electricity payment, a recurring cost they've stopped scrutinizing. Operators know this, which is part of why so much of the industry's revenue strategy in recent years has shifted from chasing new move-ins with steep discounts toward retention, keeping existing tenants paying, quietly raising in-place rates, and relying on the fact that most people would rather pay a little more than spend a Saturday deciding what to do with a decade of boxes. To see how all of this compounds over decades, rather than quarters, it helps to look at where the modern self-storage industry actually came from, because it wasn't built by a real estate conglomerate. It was built almost by accident, by a man solving a completely different problem. In 1972, a real estate developer named B. Wayne Hughes, working in Southern California, partnered with an associate, Kenneth Volk Jr., after hearing about a storage concept that had found early success in Texas. Hughes and Volk put in $50,000 and opened their first facility in El Cajon, California, under the name Private Storage Spaces. It broke even within 3 months. What's notable is that Hughes didn't originally see storage as the main event. He saw it as a way to generate income from land while he figured out its longer-term use. In his words, decades later, a method of holding prime land with income. That framing matters because it captures exactly the dynamic we've been describing. Storage wasn't the value. The land was the value. Storage was just an efficient way to make that land pay for itself, while its long-term worth appreciated. From that single facility, the company, renamed Public Storage, expanded methodically for 2 decades, buying land, building simple structures, and replicating a formula that barely needed adjusting from market to market. In the mid-1990s, Public Storage restructured as a real estate investment trust, or REIT, a legal structure that allows a company to avoid corporate income tax as long as it distributes the vast majority of its profits directly to shareholders as dividends. That single structural decision transformed the business. It meant Public Storage could raise capital from public markets far more cheaply than a typical private company, funneling that capital straight into buying and building more facilities, faster than almost any competitor could match. The company weathered the 2008 financial crisis, when national occupancy sank to its historic low near 76%, proof that even the most resilient asset class isn't recession-proof, just recession-resistant. It kept expanding regardless. By 2025, Public Storage operated more than 3,000 facilities and roughly 200 million rentable square feet across the United States and Europe, making it the largest self-storage owner in the world and a member of the S&P 500. Hughes himself never held on to the bulk of his stake. Most of his shares passed to his children over the years, and by the time he died in 2021, his estimated wealth from the company and its offshoots ran into the billions. But the more instructive part of his story isn't the fortune, it's the sequencing. He didn't set out to dominate an industry. He set out to solve a cash flow problem on a piece of land, discovered the underlying economics were extraordinary, and then had the patience and access to capital to repeat that formula for 50 years, including through the very boom and bust cycles that wipe out smaller, less capitalized operators. That's the difference between the average storage investor and a company like Public Storage today. When a supply glut hits and rents fall 11% in a year, a heavily leveraged small operator who built a facility in 2022 at peak construction costs can find themselves underwater, unable to hit the 80% occupancy line they need just to cover debt payments. A REIT with a 30-year-old largely paid-off portfolio and a national footprint barely feels it. Their older facilities are still throwing off 40 to 60% margins. They simply absorb a slower growth year and wait for the next cycle, sometimes even using the downturn to acquire distressed competitors at a discount. The current downturn, falling rents, flat to slightly lower occupancy, slowing construction, hasn't caused operators to panic so much as it's caused a visible shift in strategy. Instead of the aggressive discounting that characterized the pandemic-era land grab for new tenants, large operators have pivoted hard toward retention, improving the digital experience, tightening security, and trying to reduce the number of existing tenants who leave, rather than racing to undercut competitors on move-in specials. Digital pricing tools now let operators adjust rates unit by unit, almost in real time, squeezing revenue out of the tenants least likely to notice or shop around, while sharpening discounts only where genuinely needed to fill empty units. New construction has also cooled sharply. Monthly spending on mini storage construction had dropped roughly 18% from its late 2023 peak by the second half of 2024, as developers and lenders, chastened by falling rents, pulled back on new projects. That pullback matters because it's the industry's natural correction mechanism. Fewer new facilities breaking ground today means less competing supply flooding the market 2 years from now, which is roughly the lag time it takes for oversupply to work itself out. There's also a demographic tailwind quietly building in the background. High mortgage rates have effectively frozen millions of homeowners in place, unwilling to sell and lose a low interest rate, but also outgrowing the space they have. That mismatch is pushing latent demand towards storage as an overflow valve, even if it hasn't fully shown up in the numbers yet. It's a reminder that this industry doesn't just track the economy in general, it tracks something more specific: how mobile Americans are and how much friction exists in matching people to the right amount of space. So what does ownership in this industry actually look like today, depending on who you are? If you're a scaled operator with a mature portfolio, facilities built years ago, largely paid off, sitting in markets with real population density, the realistic outcome remains excellent. Even in a down cycle, you're likely running NOI margins in the 40 to 60% range, backed by an asset class that has historically outperformed most other commercial real estate on a total return basis, precisely because it survives recessions and merely stumbles through supply gluts rather than collapsing. If you're an individual investor buying land and building a new facility today, the picture is considerably less certain. You're stepping into a market where rents have already fallen double digits year over year, where the easy 95% occupancy environment of 2021 is a memory, and where you'll need to survive the lease-up period, often a year or more of below break-even cash flow, before you ever reach that crucial 80% occupancy line. The best-case outcome still exists: a well-located facility in an underserved suburb, built at a reasonable cost, can absolutely reach stabilized 85+% occupancy and generate strong long-term cash flow. The realistic negative outcome is just as real: overbuilding in your specific submarket, a 2 to 3 year price war with nearby competitors, and a facility that limps along near that 80% line without ever generating the free cash flow the pitch decks promised. Go back to the opening assumption that storage is a boring, low-stakes side business built around people temporarily needing extra space. The reality underneath it is almost the opposite. It's a business engineered around cheap land, minimal labor, and a psychological tendency almost every person shares: the discomfort of confronting what we own and how much easier it is to pay a small monthly fee to avoid that confrontation entirely. The margins are real, the land economics are real, and the 50-year arc from a single $50,000 facility in El Cajon to a 200 million square foot global REIT is real too. But none of it works without that quiet, unremarkable human habit sitting at the center of the whole model. The fact that once something is out of sight, most of us would rather keep paying than deal with it. That's what you're actually looking at. Every time you drive past a row of metal doors and don't think twice about it. Not a storage facility. A very efficient machine for monetizing procrastination, built on some of the cheapest real estate in America. And it's been quietly one of the best performing asset classes in the country because of it.